With the market still going higher and higher, with everything seeming too expensive for most investors, I do want to show you that even the biggest of the biggest are still not that expensive or as expensive as you would have thought. Now, company number one is company that I own personally. Actually, I own both of those companies. So the full disclaimer, I own both of the companies that will feature in this video. Both of them are trillion-dollar companies. You know them, you use their services. Now, let's get started with company number one, that's Meta Platforms. Yes, Meta, as you can see, has had an incredible recovery story. I mean, recovery and then some, right? I mean, this is one hell of a V-shaped recovery from back here late 2022. You can actually check out my videos from then. I was pretty bullish. I was buying the shares. Nobody was very interested in that at all because everybody was saying the same thing over and over again. Oh, Meta is dying. Who's using Meta services? They are burning all of their cash for their metaverse, reality labs, etc., etc. Never going to work. This company is done. Well, little did they know what was coming. And even back then, you didn't have to know everything that's going to happen with AI and whatever. You just had to look at the business as is. What they had to do is stop spending that much money, get costs under control. It does solve the problem for a ton of great companies. I mean, look at that recovery and look at the forward PE, for example, for Meta. 25.8 times. You would have thought we've been much higher than that, right? After this performance. But no, actually not that high. So let's discuss Meta. Let's discuss the second company in this video. A couple of news related topics as well. If you enjoy this type of videos, leave it a thumbs up, subscribe. If not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/gotchainvestor. Thank you very much. Full disclaimer, when you're watching this video, I'll probably be in the south of France playing some tennis, so the prices of the stock might be a couple of days early. But all in all, everything that I say in this video will be valid next week unless the stock completely crashes or goes up by 50% or something, which I doubt will happen. Anyways, let's continue. Right now, the average analyst price target is still 2.6% higher than the price we're at today. And if we look at forward PE, EV to EBITDA, price to sales, price to free cash flow, yes, they're all a bit higher than the 5-year mean, but again, not that expensive. If you look at price earnings to growth, that's it at 1.45, which, as I've said in the past, in my opinion, not expensive at all. We've seen companies at 1, at below 1. That's basically what's considered officially undervalued when you're under 1. It's 1.45 for a company like Meta. I think not expensive at all. Now, if you want to make the comparison here between Meta, Alphabet, and Apple, this is basically it. By the way, if you want to do this yourself, this is Coifin. I have a link down in the description and in the pinned comment. You get 20% off, you help yourself, and you help myself. And by the way, thank you everyone that has been using the link more recently. I really appreciate that. So what you can see here is, of course, Apple being the most expensive on all of those metrics. Then you've got Meta with a higher PE than Alphabet, with a higher price earnings to growth, but lower price to free cash flow. That's in the last 12 months. Meta does have the highest price to sales ratio, followed by Apple, and then Alphabet at 5.5 times. Then if you look at EV to EBITDA, it's again Apple, Meta, and then Alphabet. And so if we look at Meta, by the way, we're going to do a DCF for both of the companies. But now if we look at Meta, this is, to be honest, it's quite insane, because if you listen to Zuck in the latest interview, he said that if they weren't basically taxed, or I don't know the word that he used, by Apple and Google because of their policies in the App Store and Play Store, they would have been, I think he said, twice as profitable as they are today, which is insane. Again, I don't know the exact word that he said, but a lot more profitable than what they are today. And even today, if you look at free cash flow last 12 months, it's close to $50 billion. It's incredible. Then if we look at the margins, gross profit margin at around 80%, then you see operating margin, of course, we've had those lows here, but now fully recovered to 41.2%, net income going up, total shares outstanding have come down, And yeah, a lot of people, including myself, were saying, why are they buying back so many shares at $300 or so? Well, now that we're closer to $600, it does feel good, right? Indeed. Then, like I said previously, this is basically what has happened, right? They increased spending. This is capital expenditures have increased, still quite high, but a bit lower than before. And now, of course, free cash flow has gone up because, well, the business is just doing much, much better. And, well, this is what you're seeing with the stock price. Contrary to a lot of anonymous accounts tweeting out the same lies over and over again, well, if we look at family daily active people, family monthly active people, still continues to grow, still in the billions. So yeah, Instagram, WhatsApp, Messenger, Facebook, Threads, you name it, very, very popular still. We even got more numbers more recently. Teens are voting Instagram as their favorite app. That has improved again to 32% from 30% and 23% in the prior two surveys, the highest level since pre-COVID. Usage per month inflected meaningfully to around 87% from the prior 80%. If we then look at, well, Instagram compared to TikTok, Snapchat, Pinterest, Twitter, X, and Facebook, for the US teens, well, it is the most used app. Then if you look at the $500 billion online ad market, you can see players like, of course, Meta, Snapchat, Pinterest, Amazon, Alphabet with search, YouTube ads, Google Network. You also have Microsoft LinkedIn and Microsoft Search as well. It has basically, 4x, close to 4x in the last 9 years or so, and continues to grow. Now with Meta, of course, the big investment is in AI, data centers, but also hardware such as the Quest 3 or the more recently announced Quest 3S, Quest Pro. Then you've got, of course, the Meta Ray-Bans and the future augmented reality glasses, which were announced. Well, it's a product that will not be released, the current Orion version. But to be honest, this is what I'm most excited for just because of the tech. I love these types of things. I personally own Meta Ray-Bans. I own a Meta Quest as well. And I will probably own the future, wide release Orion glasses as well. I think this is the exciting stuff that is happening with AI, is that you can get to places with software and hardware that you couldn't get before. And then you get some cool hardware. So yeah, whenever they will release Orion, I don't know. But right now you can enjoy the Quest and the Ray-Ban glasses. Oh, one extra thing here before we move to the reverse DCF, there was an event from AMD and they said the following: the Meta Llama 405B model now runs exclusively on the new AMD chips for all live traffic. Meta also announced that they have installed 1.5 million EPYC processors. So great news for AMD, and to be honest, it just shows how crazy good Meta is, and to be honest, probably the leader in AI, let's be honest, from the big tech companies. Then if we go and plug in some numbers to see if it's too expensive, if it's not realistic, we see the following. So we've got the free cash flow that we've just seen, the terminal growth rate, the discount rate, and then the implied growth rate to justify today's price, or the price, well, at the time of making this video. And the implied growth rate right now is just 5.3% for Meta. And we've seen it's expected to grow more than 5.3%. Of course, this is 5.3% for the next 10 years, but still quite low, right? I mean, I would have thought that this number would have been much bigger, especially after the huge run-up. But no, it is not. It still sits at 5.3%. Moving on to company number 2, and to be honest, this feels like a Meta 2022 type of scenario for Alphabet Google. Yes, I've been talking more and more about this company because the stock hasn't really moved that much more recently. Yes, year to date, it's up 16.32%. But yeah, I mean, the last 3 months, it's down 14%. So there is quite to talk about Alphabet right now, especially with the antitrust issue, Department of Justice, etc., breaking up the business, yes or no. But this could present great opportunities for long-term investors. Yes, this is a company worth $2 trillion, But for a company that is that strong, right now, forward PE 20.2 times? Seriously? That's it? For a company like Alphabet. By the way, Meta is buying back a lot of shares, paying a small dividend. Same with Alphabet. Both of those are now paying a small dividend as well. So you're getting that on top of everything else. Plus, if you look at Alphabet as a business, right, we've talked about the breaking up part and stuff like that. By the way, if they do get broken up, depends what aspect of the business. But you as a shareholder of Alphabet will probably benefit from that because the sum of the parts is probably more than $2 trillion. So, I mean, that's my opinion. And if we're being honest, I don't really see how they will succeed in breaking up the business. There is a hearing, I believe, that's in April of 2025. And then a real one or a second one in August where the decision will be made. So it will take a lot of time. Plus, like I said previously, are you really going to go after Alphabet today when I've just shown you that the likes of Meta, Snapchat, Amazon, Apple, Netflix, TikTok, all of them are also generating billions of dollars in advertising? Then you can also make the case, right? We've been hearing about, who uses Google search? Well, it's still the dominant player by far, but quite a lot of people are using Perplexity, ChatGPT, Claude, Instagram search, TikTok search. So there are plenty of other options out there. So to come at Google today in 2024 is a joke to me. Plus, how are you going to convince me personally that, they are the bad guys? Yes, it's true that Google search sometimes, if not a lot of times, could be a bit more neutral, right? But the products that they offer to the broad public, one of the best products in the world that you can use for free. So, yeah, it's not like they're pricing people out. No, it's free. Google search is free. YouTube is free. I believe even Android is free. There's just a licensee aspect to it. So, yeah, that's to me that's a laughable case. But okay, moving on. Currently, the average analyst price target sits 24.3% higher than the price we're at today. And of course, the valuation metrics we've just seen with Meta and Apple, it is the cheapest one of the bunch. Now, looking at free cash flow, total revenue growth, we can see it growing around 13% or so for revenue. We can see that free cash flow in the last 12 months sits a little bit higher than $60 billion, but it's expected to grow in the coming fiscal years. I mean, fiscal 2026 expected to be $105.8 billion in free cash flow. Not too bad. Looking at the different aspects of its business, yes, it's true that the largest part of the business, the big chunk of revenue still comes from Google search. Then what you have is YouTube ads, Google Network, Google subscription platform and devices, and then Google Cloud. My previous video about Google explains how Google Cloud can be a huge cash cow for Alphabet, for Google, because of their growth rate and because, it is becoming more and more profitable. I mean, as you can see it right here, revenue is growing fast and operating income is now positive and growing as well. Now, with regards to Google, of course, there is also the aspect of, free cash flow is not that stable. It's not growing much. Well, you can also see that capital expenditures have increased as well. So this is a company that is also investing quite a lot, still needs to get costs under control, a la Meta. Yes, there were some layoffs, but in my opinion, they're not as aggressive as Meta. Maybe that will change. Plus, with Alphabet, you also get some other bets. You get the Pixel phone, you get Waymo, which if it works out, I mean, that's another multi-$100 billion business, if not more. You've got DeepMind, which by the way, Demis just got the Nobel Prize. So you've got some great AI talent at Alphabet. Then doing a reverse DCF, so you plug in the numbers here, the free cash flow that we've just seen, terminal growth rate, discount rate, you get here an implied growth rate of 6.53%. That's the implied growth rate for the next 10 years to justify today's price. Again, just like with Meta, I don't think this is very expensive, especially not with Google Alphabet, even with the pricing metrics, right? The forward PEs, the price to free cash flows and all of that. I mean, we've seen smaller companies, less profitable companies that are trading at a higher premium than this. So yeah, I own both of these companies in my portfolio. Yes, sometimes we are, as retail investors, we are looking for the shiny diamonds. I'm not saying I don't have smaller positions that are riskier, but the upside might be 10x, 5x, right? This is a $2 trillion company. For a 10x to happen, it's $20 trillion. So no, this might not happen, but could it get you better than market returns? Probably yes. Well, at least that's where I'm putting my money on. So hopefully I'm right. But this video was basically just to show you that yes, trillion-dollar companies can still be cheap, can still grow faster than many other companies, and in many cases be a safer investment as well, especially in this day and age of tech and AI, where if you want to participate, you already have to spend quite a lot of money to just participate in the game. To dominate, to be honest, they have no chance. Only the big ones will succeed. So that's about it for me in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if not, and I'll see you all in the next one. Bye bye.